The Morgan Report with David Morgan. Discover how to build and protect your wealth at themorganreport.com.
David Morgan with the Morgan Report for the week ending 22 August 2025. Start off with the warehouse receipts, or warehouse holdings, I should say, for silver. And you can see this is right from CME Group. And the depositories are listed here on the left side, which there are several more than there were, let's say, a decade ago. The big ones are still here, all of them really. Brinks, of course, Coins and Things, Delaware Depository, HSBC, I won't read them all. JP Morgan, as I mentioned, StoneX, Monera. So anyway, that is everybody. And then there are two categories. Anyone that's followed me for very long has heard that several times. There are in each of these holdings a registered and an eligible. Eligible are eligible to be delivered, but they need to have a signature to get a medallion to put them into the category. So for all practical purposes, if it's an eligible, it's a long-term holder that's just storing it there in a safe place, happens to be at a COMEX warehouse or vault, and it's kind of just resting there. The working inventory, what can be moved off the exchange instantly, is the registered category. And I've highlighted the totals here at the bottom. So in the registered category, there is, as you can read, I won't the whole number, but 190 million plus in registered. In the eligible, 317 million, for a total of 508 million. Now, there was a mention of an interview that I did, I think it was about 7-8 months ago. And this registered category is actually below 35 million, which I've seen it do that a few times. And in the previous times that occurred, that's a pretty small amount that's right there registered, ready to go for delivery. So someone could come on and, stand for delivery and, kind of wipe it out or diminish it. And in those cases previously, it didn't last very long. I can't tell you the exact amount. I'd have to look, but just a matter of weeks, 4 weeks, 6 weeks. Got below that recently, and it stayed there for what I consider to be a bigger duration in time. And it looked as if, it wouldn't take much to nudge that, test it or whatever. Well, from the time I was thinking that until now, this inventory has built up significantly, and I'm going to address that later in this update. So next up, I'm going to take a quick look at the Commitment of Traders Report, the last one issued, which is 19 of August, a few days back, and you can see the total open interest. Here's the number of contracts. The non-commercials, the trading funds mostly are long, and they're always net long, 68,000. Net long, 21,000 short. You subtract that number from that number, you get 6 minus 2 is 4, so you got about 47,000 net long on the non-commercial side. The commercial side do the same thing, but they're always net short, 111,000 short, 45,000 long. Do the math there, and of course the difference is made up by the public. Really, these are small people, and of course they always balance. For every long, there's a short. But there's been talk, at least what I think I've heard, about, massive shorts and all that. This is actually not, it's come down quite a bit. I'm going to show you that next. But the commercials have been covering their shorts. And the idea that at some point these shorts need to cover, and they do, but they never cover them all. And the short squeeze can happen. There's no doubt it happens in the futures markets. It's kind of a rare event. The point being is that I think that situation is overstated at this point, and I'll show you why here in a second. All right, so quickly going to look at gold futures. This is Commitment of Traders in graphic form. And as you can see, the open interest has diminished quite a bit from where it was back a few months ago. And the amount, they always match longs and shorts. So you have the commercial basically here and the other side here. As you can see, it's come down quite a bit here, and then it's kind of leveled off. So gold has gone sideways in that time frame, and we're at a position where open interest is around 300 million. Now we're down to around 200. Is it sufficient of a level for the gold market to start moving up based on the COT? And this is an art, not a science. I've stressed that over and over again. The answer is yes. Will it or will it not? Remains to be determined. I've said that I thought this consolidation would take place through the summer. Summer officially ends in early September. We're getting pretty close. Does that mean right after Labor Day it shoots up? Not necessarily, but something to pay attention to. So if we move the silver market, we can see a similar situation to what I just showed you in gold. The open interest peaked back here. It's come down, as you can see here, verified with the shorts and the longs. And again, the same question, are we at a sufficient level where we could see it start to move up from here? And the answer is yes. I mean, you can see the extremes here, for example, way back here where there's not hardly any open interest. It's very, very low. And you can see that you get a low here. See, it's pretty low here, and it's gone sideways. So it's not an exact science, as you can tell. This whole time that the open interest was higher, and you could see in the red and the blue as they moved back and forth, ebbed and flowed, we basically still had a nice up move, and that trend will continue. One thing to note is Powell's speech that happened on Friday and what happened to the silver market. As you can see here, the volume bar here going up is green, going down is red. Huge move up. This came from Bob Coleman, and it shows you we basically went from about 37.80 to about 39 or so, and that was a big move. And this is the anticipation that interest rates will be cut, and I think they're only talking a quarter point. We'll see what happens, but it's interesting that silver is anticipating stronger moves if interest rate cuts take place. So this is on my Twitter feed. And there's another one here from Bob, and you're seeing this triangle formation, which obviously means as a technician it's got to break one way or the other, up or down. And of course, it's very common sense. If it breaks to the upside, we got further moves to the upside. And if it breaks down, which is a possibility, we'll certainly see it move downward somewhat. Get a little clearer picture there, and you can see the volume here at the bottom. This is a very interesting chart. This is from Luke Groman. Shout out to Luke, created with TradingView. As you can see, this blue line is the SPX, Standard & Poor's, in terms of gold. You can see it's basically going sideways. And this is, of course, what you hear on the financial channels over and over. But since the tie to gold was severed in August 15th, 1971, as we know, it's 54 years ago, plus a couple weeks. And we see they're fairly close in here to the mid-80s or so. And from that time, we just get this huge parabolic move. I mean, that is one heck of a move in terms of what the numbers are, going from like under 500 all the way to, currently 6,339. Yet in terms of gold, it's basically a bit off from the beginning. So if you look at the constant gold and you price the SPX, that's what you see. Very few people know that, understand it, or even think about it. The last one I'll show you from my Twitter feed before I make a summary here. SRS Rocco's report. I reposted it here, and it's showing the Saudi central bank came into the iShares Silver Trust quite heavily. About 9 million ounces worth of silver went into the SLV recently, and corresponding shares here. I probably should have mentioned, I'll do it now before I close out, that the managed money side on the commitment of traders is actually fairly low. I said it was, but didn't emphasize it. It's at a point where I said it could, should, might go up. Obviously, it did on Friday. And it's actually at a point where it's probably more bullish than I indicated, but just because that's the indication, it doesn't guarantee it. The COTs are very useful, but they're not that great for timing. It's just like a stock or a commodity being overbought. It can be overbought. All the technical indicators indicate it's overbought, but it can stay overbought for a very long time. So anyway, back to the wrap up here, talking about the ebb and flow of physical silver in and out of the COMEX. So over the past 6 months, COMEX vaults have seen some large metal movements, larger than we've seen in years. Silver stocks have surged from 359 million ounces in February to over 500 million ounces today, an extraordinary 150 million ounce build. Yet despite that inflow, deliveries remain strong with, as I said, 9 million ounces taken out so far this month. That was to the SLV. And gold has followed a similar path this year, peaking at a record 43.3 million ounces in March after a flood of shipments into New York. We've discussed that in the past on these weekly updates. Since then, holdings have eased back to about 38.6 million, but deliveries in August already exceeded 3.3 million ounces. The key takeaway is that demand is alive and well. I'm seeing more flows in and out of the COMEX than what we would consider normal a few years back. Metals pouring into the COMEX, but just as quickly, significant amounts are flowing back out to satisfy delivery. Compared to the past 5 years, the scale of both inflows and offtake is extraordinary, signaling that there could be stress in the metals markets. I'll leave it at that. This is David Morgan of themorganreport.com, signing out. I'll be back next week with another weekly perspective.
The U.S. government debt is about to cross $37 trillion. That's not a typo. That's trillion with a T. Tariffs are being used to try and even the playing fields. Global supply chains are shifting. Inflation isn't going away. And the value of your dollar? It's quietly being drained while no one is really talking about this. The truth is, we're living through the early stages of a financial reset, whether anyone wants to admit it or not. And if you're still relying on mainstream headlines or financial advisors who just tell you to write it out, you could be blindsided when things really shift. That's where the Morgan Report comes in. For over 25 years, David Morgan has been helping investors cut through the noise. He tracks what actually drives markets, from precious metals and mining stocks to global debt and monetary policy, and show you how to protect and grow your wealth when the system is under stress. This isn't just about gold and silver. It's about having a clear-eyed view of where things are headed and making sure you're not caught off guard. The Morgan Report gives you real research, honest analysis, and strategies you can act on, even in a world of rising debt, unstable currencies, and economic uncertainty. Go to themorganreport.com today, download your free report, get informed, get ahead, and take back control of your financial future. Themorganreport.com, because $37 trillion in debt won't